Hey, I'm Mike Finnen from Buttonwood Tutor Academy. I worked for 37 years on the New York Stock Exchange floor as a trader and principal in multiple broker dealers, and now I'm helping you to pass your FINRA series exam test. I can make the hard stuff seem simple. Let's get into it. Today we're here to talk about shareholder rights. We are going to probably wind up doing a couple of videos on shareholder rights because there's so much to cover with it. There are right when you own shares, when you own shares of common stock, there are rights that come along with it as an owner because that is what you are. One of the rights that you have is that if the company has earnings that they pay back in dividends to the shareholders, you get your prorated amount. If you own 10% of the company, you get 10% of the dividends. If you own 1% of the company, you get 1%. If you get 0.001%, you get that part. You're an owner. When you own stock, when you own equity, you are an owner. The most likely type of dividend paid and the most that people know about are cash dividends that are literally cash paid. So if a company made, say, $5 in earnings for the year and they pay out $4 in dividends for the year, that is something you'll get once. It's paid every quarter. Say it's usually in equal amounts or semi-equal amounts, $1 a quarter, and you get that cash. Now, when one of the things that happens though is that when the cash goes out to the shareholders, the stock price gets lowered by the amount of the cash dividend. So let's say a stock was trading at $50. Well, it would the day after the dividend, ex-dividend would trade at 49.75. And if there were any orders on the book below $50, they would be reduced by a quarter. So what would that be? That would be buy limits, or it would be sell stops. Remember Schwab's Blitz, sell stop is below the market. And the only orders that wouldn't be that happen to is if it's a DNR, which is not do not resuscitate, it is do not reduce. Those would stay the same. The next kind of dividend that we have is a stock dividend. Growth companies like to pay stock dividends because they don't have to actually pay anything. What is a stock dividend? They give you more shares but at a lower price. At the end of the day, you wind up with the same amount of value as you had to start with. But how do we figure these out? Let's say that you had a company that paid you a 25% stock dividend and you had 100 shares at $100. Well, you would take that 25% and decimalize it, make it 0.25. Add a 1. So now you have 1.25. One share with the 25% dividend on it. And then you multiply that by the total amount of shares you have. That'll give you your shares. That'll be more shares. Then you take that and divide that by the stock price. That'll give you less stock price. You'll have more shares, less stock price. Higher cost basis, less stock price. But you will wind up with the same amount of money in the end as you did in the beginning. So you're not getting more money, you're just getting more shares. It's a form of stock manipulation. Next, we have what we call product dividends. A product dividend is, say, Nike might send out Air Jordans to the shareholders, or Amazon might send out Kindles. They're not very likely anymore. They don't happen very often anymore. But also, one thing you need to know on the test is that these are taxable. You will get taxed on any product dividends that come through. All right, moving along. Next, we have the board of directors. What are the board of directors? The board of directors are people elected by the shareholders who are much like the democratic republic that we live in. You elect them, and then their job is to represent you, but you don't have anything to do day to day with the operation. They're running it from the higher end. So actually what they wind up running is they're hiring and firing the executive level people at the company, and any big decisions, any changes with the company they'll be involved in. Also, they decide who pays the dividends, right? Because you can't have the shareholders decide the dividends. That would be like putting the inmates in charge of the asylum. Not going to be good. All right, so next, what are the different kind of shares we have? Statutory on the test. Statutory versus cumulative. Statutory shares are, if you have one share, you get one vote. At a board of directors meeting, there might be 3 new open board seats and 10 people running for those seats. If it's statutory, you get one vote for each seat. You get to vote for one person for each of those seats. If you have cumulative, and it's the same situation, 10 people running, 3 seats open, you can combine all your shares. So let's say you're at 100 shares, which is one vote, 100 votes, and there's 3 items. You can now vote 300 votes for one person. So statutory voting favors the institutional investor. Cumulative favors the retail investor. Next, what we have is a person or a company called a transfer agent. The transfer agent is hired by the issuer to keep track of who owns stocks. They make sure the dividends get paid. They make sure the proxies go out to the shareholders for the board of directors. They make sure the bond people get their bond interest. They have a list of who has bought and sold the stock. And what is a proxy, by the way? The proxy is voting material, right? So you are allowed to give your proxy to another person. You might have heard that like slang in a movie. Oh, I gave my proxy to that guy, right? Or I gave her my, or every husband in the world, right? I gave my proxy to my wife. So basically what that's saying is that you have given the other person a right to vote for you. And in this case, mostly that comes down to, since most stock is held in street name, then most shareholders give the proxy to whoever their broker dealer or whoever holds their shares are. Now, as far as the board of directors meeting goes, even if you give your proxy, let's say you're with Schwab and you give your proxy to Schwab, if you show up at the meeting, you're actually still allowed to make your vote, even though you gave them your proxy. You gave them your voting material. If you can make it to the meeting, you get to do the voting. All right. Another right that you have is the right to records, transparency. And the way that we do that is really through the 10K and the 10Q. The 10Q is the quarterly report that all securities, unaudited quarterly report that all securities have to send to the SEC. And then the 10K, this is the big time. This is the audited yearly report. This has to be correct. This is the income statement, the balance sheet, whatever else has to be there. It's all got to be in there. And that is one of the ways. Another way that shareholders can keep track of books and records, if you're a little more sophisticated, they have an SII, they call it, which if you request it, the company has to give it to you. And that's a much more detailed record of how they invest, of what they invest in. And, generally speaking, that would be a very sophisticated investor ask for that. Okay. As far as the shares go, let's talk about how they're divvied up. First shares we have are called authorized shares. Authorized shares are the maximum amount that a company can create, and that is in the corporate charter. Next, we have issued. Issued shares are the authorized shares that have been given out to the public. They're trading in the secondary market. They're in the hands of investors. Unissued or non-issued shares are the ones that they kept in their pocket. So you might have had, say you had 10 million authorized shares, and you give out 6 million issued to the public. You have 4 million shares non-issued or unissued that you can later use for an APO to raise more money. And that's what companies do. That's why companies give part of their ownership up, is they get capital. And if later on the price goes up and they get more capital, they want to do it. Another thing that happens is we have company buybacks. And this has been pretty controversial over the last 20 years, that companies seem to be using the technique of buying back shares more than actually growing. And what it is, if you buy back shares, that raises your earnings per share, so it raises your price. Buying back shares takes away issued or outstanding shares. You're literally buying the shares back in the open market. And lastly, what we have is outstanding shares. What are outstanding shares? Outstanding shares are issued minus treasury equals outstanding shares. Those are the shares that are in the public's hands. Those are the shares. Now also, again, outstanding shares times market price, that's the net worth of the company. Okay, lastly, let's talk about dilution. What is dilution? Diluted, just like think about, when you're cooking something, if you put more water into it, you're diluting it. It's not as strong as it was. So dilution in stocks is that if you saw Facebook, okay, Mark Zuckerberg had a partner, I think his name was Saverin, I don't remember, I thought maybe Mark Saverin also, and it was a guy he knew at Harvard who put a certain amount of money into the company, $19,000 invested when nobody had anything, and for that he got, say, 30% of the company, so 30% of Facebook. But then down the line, the lawyers got involved, and what they did was they diluted the other Mark, not Zuckerberg, Saverin. And so say he owned 1 million shares and there were 3 million outstanding, so he owned 30%. Well, now they created 300 million new shares, so now he only owned 1% of the company overall, that was the dilution we're talking about. Or to make it simpler, if you owned 50,000 shares and there were 500,000 shares outstanding, you own 10% of the company. So now let's say that the company decides to issue another 500,000 shares because they want to raise money, and you still only own 50,000. Now you only own 5% of the company. So here's what happens. The company gives out preemptive rights. These are nice, okay? A preemptive right is that they give you the right to buy enough shares to get you back to whatever your original ownership level is. One right is one share. One right is one share. These are short term. They're offered for 60, 90 days, and they do trade on their own. So if you had, in this case, if you had 50,000 shares, you get 50,000 rights. You have the opportunity to buy 50,000 new shares. And here's the good news. It's at a discount. If the stock was trading at $50, you're allowed to go and buy it at $40. So it's free money. It's free money, yo. And that's why these things are so valuable. So as an example, though, let's say that you owned 100 shares, which gives you 100 rights. And then they say for every 40 rights, you get 2.5 new shares, okay? So at that 2.5 new shares, for every 40 rights, you get 2.5 new shares. In this case, you have X amount of rights, so you wind up with however many shares you wind up with, but you actually can round that up. So if you wind up owning 3.2 new shares, you round that up to 4 shares. So here's the deal with the preemptive rights again. One right equals one share. So you can do one of three things with preemptive rights. You can exercise them, you can trade them, or you can let them expire. Marry, smash, or kill, okay? But letting them expire is considered fiduciary malpractice because it is free money. Again, remember what I told you. These are offered to you below market price. So if you decide you're going to exercise them, you exercise them into the new shares, and then you get your new shares, you have equal ownership. But if you just want to sell them, these trade on a when issued basis. You could just sell them in the open market for a profit. They trade for whatever the difference is between the market price and the preemptive price, and a little less than that, they're going to trade. If you let them expire, you're just giving away free money. So for every 100 shares, say you get 100 rights. And then what they'll say is, okay, for every 40 rights, you get one new share. Okay, so you take that and you divide that into, say, 100. Now you're getting 2.5 new shares. Okay, well, here's the good news. More good news. If you own 2.1 shares when they do the conversion, you go immediately to 3. They round up to 3. It's not like, this 5th grade math where 0.5 and higher round up. They literally round up from the lower number. So again, preemptive rights are a good thing. They're a way to keep you from getting diluted, so you don't wind up getting a movie made up about you about how you got screwed. And this is just another reason that equity is so important. So much of the Gordon Gekko on Wall Street said, there's 3 ways wealth is made: real estate holdings, inheritance, and share and equity. Well, I got news for you. These days, mostly it's equity. The richest people. The richest people in the world, the Elon Musk and the Bezos and the Zuckerbergs of the world, they are now worth 2 and 3 times the amount, inflation adjusted, that Rockefeller, Carnegie, and Vanderbilt were back. They call those guys the robber barons, okay? These guys are now worth 2 and 3 times that in inflation adjusted, and it's almost entirely based on equity holding. Now, in no way, shape, am I saying that's going to last forever, but the way that things are going right now, owning equity is probably the way to go. Thanks for watching this video, and hit subscribe if it helped you out. Now, is your exam date coming up? Well, don't study alone. Find a study buddy to work with, or a study group, or book a one-on-one session with me at buttonwoodtutor.com. I can help you find your weak points, build a study plan, and generally getting you ready for this test faster. That's what 37 years on Wall Street will do for you. So, go book a session, get ready now, and it's showtime. Me and you get ready.